In Chapter 19, we'll be going over three different separate topics. We'll go over multi-product break-even. So what that means is what happens if you have more than one product. Let's say that I'm a business and I make two different products. How do you figure out break-even if you make two different products? And each product has a different selling price. Each product has a different variable cost. We'll go over multi-product break-even. Also, we'll go over something called contribution margin per limited resource. Now, this is actually a pretty simple concept, so I'll show you a simple way to understand that concept. And finally, we'll talk about degree of operating leverage. Degree of operating leverage just means how much fixed cost you have. So let's begin. Okay, so looking at the notes, you can see that this is from last chapter. So again, a couple things. Sales revenue minus variable cost is called contribution margin. Remember, you can have two kinds of contribution margin. This is total contribution margin, or they just call it contribution margin. It means for the whole thing. $200 is unit contribution margin. So unit contribution margin means what is your selling price per unit minus your variable cost per unit. That's called your unit contribution margin. Once we subtract out our fixed cost, we have net income. Now, this is a basic cost volume profit income statement. Here's a more detailed version. So this is basically the same idea as before. So in this example, you can see sales are 800,000. Variable cost is 480,000. Contribution margin is 320,000. You have your fixed cost, 200,000, and net income. Now, what they do here is they break everything into variable cost and fixed cost. Notice that cost of goods sold appears twice. It's 400,000 here at the top, and it's 120,000 at the bottom. The reason why it appears twice is because you can have variable cost of goods sold and fixed cost of goods sold. You can have variable selling expense, which is 60,000, and you can have fixed selling expense, which is 40,000. And the same thing with administrative expenses. Okay, so the prior slide, make sure you are aware of that. So in the homework, it's going to ask you what happens if your selling price goes up or if your variable cost goes down. So you can figure out how that's going to affect the different numbers in your income statement. But here, let's talk about weighted average. Okay, so here's an example. So we have Vargo Electronics. Okay, so they sell two products. They sell cell phones and televisions. Okay, so it's saying here that they sell 1,500 cell phones and 500 TVs. So how many total units do they sell of everything? Well, 1,500 plus 500, 2,000. Right? So if they sell 2,000 units of all of their stuff, what percent of their total production is cell phone and what percent is TVs? Well, they sell 1,500 cell phones, because it says so in the illustration. Divide by the total of everything is 2,000. So 75% of their total production is cell phones. And they say that they sell 500 TVs. Divide that by 2,000 units is the total for everything. They sell 25% TVs. So 75% cell phones, 25% TVs. If you were to add 75% and 25, it's 100%, because that's 100% of everything is selling cell phones and TVs. Okay, so 75%, 25%. Now take a look at this example here. Here you have selling price and variable cost and unit contribution margin. So it looks like cell phones have a totally different cost structure from TVs. So this is a problem because if somebody says, what is the break even? To figure out break even, I gave you a formula sheet, but here we have two SPs, two selling prices, two contribution margins. So what do? Well, you have to combine everything and create what we call a weighted average. This is a weighted average contribution margin per unit. Weighted average unit contribution margin. How do you get this number? Well, the contribution margin per unit for cell phones is 200 times we sell cell phones 75% of the time, plus the contribution margin per unit for TV is 500. And what percent do you sell TVs? 25%. So if you do the math, 200 times 0.75 plus 500 times 0.25, that's $275. This is important because this is called the weighted average contribution margin per unit. Okay, so let's take a look at the next slide. Okay, so remember a weighted average contribution margin is $275. Okay, so how do you figure out break even in units? Okay, that was on the formula sheet, but the formula is here. Fixed cost divided by weighted average unit contribution margin. Okay, now for those of you that are curious, on this handout here, important formulas, how do you figure out break even in units? Fixed cost divided by SP minus VC. Selling price per unit minus variable cost per unit is also called unit contribution margin. Okay, so this is the formula that we use. So basically it's the same thing that's written here. Okay, so fixed cost is $275,000. That has to be given to you. And then you divide by the weighted average contribution margin, $275. So what is the break even in units? It's 1,000. That means we have to sell 1,000 units total to break even. Now, if we sell 1,000 units, that's total. Remember, 75% of the time you sell cell phones, so 1,000 times 75%. How many cell phones do I have to sell to break even? 750. 1,000 is the total number of units I have to sell to break even, times 25%. So how many TVs do I have to sell to break even? 250. This is the answer for break even. Okay, so this is just saying that if you sell 750 cell phones, 250 TVs, your total contribution margin would be $275,000, and your fixed cost is $275,000. That's just a fancy way of saying you break even. Okay, so remember, if you're going to figure out break even and you have more than one product, you have to figure out a weighted average break even. Okay, so let's take a look at another example here. Okay, so I'll interpret this for you. The important thing is just to get the concept down. Okay, so I make $200,000 in sales from my indoor plant division, and I make $800,000 in sales from my outdoor plant division. So for everything, the total, I sell $1 million. So what percentage of my sales come from indoor? Well, I make $200,000 of my sales from indoor, divided by my total sales for the whole thing is $1 million. So 20% of my sales come from indoor. And here, 800,000 is what I do for outdoor, divided by $1 million. So 80% of my sales come from outdoor. Okay, so then let's figure out the contribution margin ratio for indoor and outdoor. Okay, so you can see here the contribution margin ratio for indoor is, take the contribution margin, which is 80,000, divided by 200,000. So 0.4 is the indoor plant division's contribution margin ratio. outdoor plant division, you take 240,000 divided by 800,000, and you get 30%, or 0.3. So here you see 0.32 right here. What is this called, and how did you get it? And why is it important? Okay, so this is called the weighted average contribution margin ratio. And it's important because you need this number to do break even, target profit. You need this number to do everything that we're learning in this chapter. And how do you get this number? Well, we take the contribution margin ratio for indoor. Remember, you sell indoor 20% of the time, plus the contribution margin for outdoor. Remember, you sell that 80% of the time, so that's 0.32. This is called the weighted average contribution margin ratio. So what if I want to figure out break even in sales? How would I figure out break even in sales? Take a look here. Break even in sales is fixed cost divided by contribution margin ratio. Break even in sales is fixed cost divided by, we have two products, so we're going to use weighted average contribution margin ratio. So they have to give you the fixed cost, but let's pretend it's 300,000 divided by the weighted average contribution margin ratio. That means the break even in sales is 937,500. That's the total sales revenue for everything that we need to have in order to break even. So 937,500 is the total sales we have to break even. Remember, we do 20% of our business from indoor plant. So 937,500 times 20% is 187,500. And outdoor would be 937,500 times 80% is $750,000. So you can see that the weighted average contribution margin ratio depends on the contribution margin ratio and what percentage of your sales comes from one product versus another product. In this case, 20% of our sales came from indoor, 80% from outdoor. Now, if the sales mix was 50-50, then the contribution margin ratio would be 0.35 or 35%. And the break even would be a different number. Okay. So here's a question. Net income would be which one of these answer choices? The answer is A. Greater if more higher contribution margin units are sold than lower contribution margin unit products. So high contribution margin means that it's very profitable, right? Every unit that you sell contributes more to your bottom line. So you would have more net income if you sell more high profit products than you would if you sold more low profit products. So here the answer would be A. Okay, so let's take a look at the next slide here. And here's a question. What is the contribution margin per limited resource? Okay, so here we have Vargo Manufacturing, and it looks like they're selling two products here, cell phones and TVs. Now, how long does it take to make one cell phone? 0.2 hours. How long does it take to make a TV? 0.625 hours. So if you take 200 divided by 0.2, you get 1,000. And $500 divided by 0.625 is $800. Now, if your time is limited Which one makes more money per hour? Cell phones. Cell phones, if you think about how much contribution margin you have per limited resource or contribution margin per hour, cell phones are more profitable. It's like saying, how much do you make per hour, right? So cell phones make you $1,000 per hour. TVs only make you $800 per hour. So if you could only make one product, which one would be better to make if you had limited resources like time? Probably cell phones would be the best to make. Okay, so again, you can see here, management should produce more cell phones if demand exists or increase machine capacity. That means, machine capacity means if you could have unlimited time, I mean, obviously you would want to make both because they both are profitable. But if you have limited resources, you'd have to focus on cell phones because that's going to give you the most money per hour. Okay, this is the last thing we're going to go over, operating leverage, degree of operating leverage. Take a look at this example here, and you'll see that both companies or both methods, this is Vargo and New Wave, both of them have the same sales revenue, it's $800,000 for each, and both of them have the same net income, $120,000. So that means that Vargo and New Wave have the same total cost. Because what's 400,000 variable cost plus 200,000? That would be 680,000. What's 160,000 plus 520,000? That's 680,000. So it looks like both companies are the same, but they're not. Because one company has more operating leverage and another company has less operating leverage. So operating leverage just means fixed cost. Fixed cost. Very important. Operating leverage means fixed cost. So which method has more fixed cost? Is it Vargo or New Wave? Clearly you can see that New Wave has more fixed cost than Vargo. Okay, so 520,000 versus 200,000. That means New Wave has more operating leverage. Vargo has less operating leverage. We can measure it this way. We can say the following. Well, what is the contribution margin ratio for each? Well, contribution margin ratio is contribution margin divided by sales. Vargo is 40%. New Wave is 80%, right? So what does that mean? Well, it means first, we said New Wave has more fixed cost, so it has more operating leverage. So what that means is that we can figure out operating leverage as a number. So DOL means degree of operating leverage. It just means put operating leverage as a number. So you take contribution margin divided by net income, right? So let's go back. Contribution margin for New Wave is 640,000. Net income is 120,000. So 640 divided by 120,000. It's this slide here. So degree of operating leverage is 5.33 for New Wave. And what's the DOL, degree of operating leverage, for Vargo? 2.67. Okay, so New Wave has more operating leverage than Vargo. New Wave also has higher contribution margin ratio than Vargo. And let's look at the fixed cost. Okay, so remember, New Wave has more operating leverage. Vargo has less operating leverage. New Wave has higher contribution margin ratio. Vargo has lower contribution margin ratio. And if you take fixed cost divided by contribution margin ratio, New Wave has higher break-even. Vargo has lower break-even. Okay, so let's summarize this then. So high degree of operating leverage means high break-even, but it means more profit after break-even. Low degree of operating leverage means low break-even and low profit after break-even. Okay, so let's see if we can see if that's true. Okay, so these are the slides here. New Wave has high degree of operating leverage. Vargo has lower operating leverage. New Wave has higher break-even than Vargo. And which one is more profitable? Which one contributes more to your bottom line? New Wave does. So that means New Wave has high degree of operating leverage, so high break-even and more profit after break-even. Vargo has low DOL, low break-even, and less profit after break-even. How do you measure degree of operating leverage? You take your contribution margin divided by your net income. Okay, so this last slide is just computing your margin of safety. Okay, so you can look at this yourself. But remember, margin of safety means how much extra you have above your break-even. Okay. So this concludes Chapter 19. If you have any questions, please let me know.